these platforms where we left the house at the time where he was supposed to eat, and now he's starving. So.
There's our cold opener right there. Welcome back, everyone, to another week of the Kingscrowd Investment Roundtable. My name is Brian Belay. I'm joined by the Kingscrowd Senior Investment Associates, Teddy and Leah. How are you both doing today?
Good, Brian. Good to have you back.
Thanks. I had a short break there on vacation, but it's glad to be back. Happy to be here and diving right back in. How about you, Leah?
Doing great. There's that tsunami warning in Auckland, so if there's too much water, I may run away from here, but I'm trying to stay.
We, as we're recording this, that tsunami warning for the Bay Area has gone out, so we hope everyone out there is staying safe and being safe. But let's get into this week's topic. So we have a couple great things we want to cover and discuss. We're going to be talking about first an acquisition in the industry where the platform Honeycomb Credit announced their acquisition of Raise Green. We will then be getting into this week's chart that we'll be talking about, showing the distribution in terms of equity investments across some of the top platforms. I'll pull up my screen and we can share and start with the acquisition announced by Honeycomb Credit this week. So Honeycomb, as probably a lot of you are aware as investors, has announced that they were acquiring Raise Green. Now, Raise Green is a platform that has tended to specialize in clean energy, kind of climate-focused investments across the lifetime of the platform. They raised over $10 million for their clients. And actually, Raise Green did a fundraise themselves, a Reg CF campaign themselves, where they raised $124K and from Reg CF and $2 million total when you include their Reg D. Now that offering, because of the way that the regulations are, and just in terms of what FINRA and the SEC allow, had to actually be done on WeFunder. This is kind of a nuance of the industry that some people have tried to talk to the SEC to be able to allow platforms to raise on their own platform. But for Reg CF, they had to raise on WeFunder. So this is actually interesting both for potential investors who invested in Raise Green, as well as people who have invested on Raise Green itself. Now, I'll kick things over. Teddy, give us a little bit of what you've kind of seen going on in terms of acquisitions, and what do you think this acquisition means for the industry and for Raise Green?
Yeah, I mean, we initially saw this a couple of years ago when Seed Invest was acquired by StartEngine, kind of starting to see the beginning of some consolidation in the space. But I think, when you look at the industry as a whole, there's probably, I don't know the latest number, but I think around like 60 platforms out there, and obviously dominated by like 8 or 9 of the largest and well-known ones and best funded ones. And I think that just shows how difficult it is to get started as a platform in this space and generate credibility with investors to not only source and portray a lot of great deals, but, just in terms of, safety of funds. And, if it's a brand new portal, it's really hard to get people to part with their money to begin with. And if it's a new portal that doesn't have a track record and, just recently listed and regulated by FINRA and all that. So I think we're probably going to start to see, and we're already seeing it, like as companies kind of break out and start getting some good traction with investors, we'll probably see the larger platforms start snapping them up, as we saw with Seed Invest. Seed Invest had some of the best deals in the industry as it was going, and obviously the behemoth of StartEngine acquired it. So I think it's going to be more and more common in the space to see this, especially as crowdfunding picks back up and other smaller platforms we'll start to see more and more traction. I think we'll see more acquisition in the space, but yeah, it'll be interesting to see if the financial terms ever come out, to see what that meant for the raise that they just had on WeFunder. So
yeah, the deal terms, well, what was this? It was at a $8 million valuation cap, so it looks like it was on a safe back then, but will be interesting to see. And then Leah, I know you focus and tend to focus a lot on impact social investments. Obviously, Raise Green was something that was there for kind of different ESG types investments. What do you think this means for Raise Green and or for Honeycomb?
Yes, I truly think that what Honeycomb and Raise Green are trying to do is to have kind of a super impact platform. What that means is that Honeycomb is already targeting a lot of raises that are related to small businesses that we know may have a little bit of more trouble getting off the ground, but also a lot of minority-owned businesses who may also face structural challenges. By adding race grain to their offering, they're also going to be offering climate related deals, which means that they are going to be a fully impact platform right now, offering investors the ability to not only invest in social impact, but also in environmental slash climate impact. So I think that this is pretty exciting because investors who usually are interested in one topic may be interested in the other one. They are also interlinked. We know that people that are less favored in society, that are poorer, are going to be more impacted by climate change. So actually investing into impact is also kind of a social impact in itself.
Awesome. So obviously anyone who was previously on Raise Green, you will probably be getting communications about what's going to happen to your investments that happened on that platform. But we've seen a couple times, both through different acquisitions like Teddy was talking about with Seed Invest, as well as, if everyone remembers, Republic actually acquired Next Seed as one of their first acquisitions a few years ago. And then some platforms have been shutting down. So Mainvest is a platform that just recently, in the past few months, announced they were going to be closing. And that doesn't mean if you're an investor on those platforms that your investments are gone, right? Someone is going to take that over. So typically there'll either be a transfer of ownership, whether it's the acquiring company, or they can move it to a different transfer agent or something like that. So definitely if you're an investor who made an investment on Raise Green, be looking out and checking your email to make sure that you kind of know what's going to happen to your investments, but you should not lose them. There should be ways that are set up through the different custodians and transfer agents to make sure that you will be able to still hold your investment moving forward. Now, all of this is also very interesting because it, as Teddy was kind of mentioning, starts talking about and getting into how the industry is constantly changing, right? There's different platforms that are acquiring different platforms. As Leah mentioned, there's strategic acquisitions to try and make them the one-stop shop for like impact investing, which I think, I believe it was a quote similar to that from George Cook, the CEO of Honeycomb Credit. But let's take a look at some charts that shows the breakdown of just what some of the top equity investments have been across some of the top platforms over the past few years. Leah, you put together a great chart for this, so I will share my screen and then hand it over to you.
Yes, right here, what we're saying is the share of equity investments across platforms for all the companies that started raising in January 2023 or later. And what we see is fascinating because StartEngine and WeFunder are the clear leaders in this market. Now, Brian, if you actually... Can you hear that sound in the background?
It was a little bit. I heard it. At first, I was like, is that me? But no.
Okay. Now, Brian, if you show us the 2022 and 2023 chart, we're going to be able to see that StartEngine took a huge part of the market. We're going to see that StartEngine really drastically increased its market share from 18.6% for our last chart to 25% now, thus becoming the official leader of the equity crowdfunding market. Another very interesting point is that Dalmore was number 3 with 21.5% of equity investment. And now Dalmore went down to only 8% of the market share. So that's a huge decrease for this platform, which was passed by DealMaker. DealMaker now has 17% of the market share, while on the last chart, we could see that it only had 7.7%. So that's plus 10% for DealMaker. And that's something that Teddy and I have been feeling a lot recently because we both look at every single company and we realized that we were seeing way more DealMaker deals. And I want to say that these deals are actually pretty high quality deals and they do raise a lot of money. Another very interesting fact is the other part of the chart. In 2022, the 7 major companies were only leaving about 5% to the 60-ish other companies. In 2023 and 2024, they're leaving 12% to the other companies, which is very surprising because what we were expecting were consolidation in the market. We were not expecting these small companies to be able to raise way more money.
Yeah, a few other observations that I take away from this. And first, just so for clarification, right, we're talking about equity investments on both of these. So keep that in mind. This doesn't include the debt platforms. That's why you don't see platforms like the Honeycomb Credit and the Raise Green that we just talked about on here. In addition, this is Reg CF and Reg A plus. So there are definitely some platforms. For example, StartEngine has more Reg A plus than WeFunder, which tends to just focus on Reg CF. So depending on how you slice and dice the data, you will often hear these platforms talking about themselves as, hey, we're the number one in Reg CF. Hey, we're the number one overall. That's why you can hear all of them kind of being number one in different ways, because it really depends on how you're slicing the data and looking at it. The other thing that's I thought, personally was interesting is Republic really did have, a significant market share. They were kind of the top three or four for the most part for a lot of the early days throughout, 2018 to 2021, 2022. But definitely saw them pulling back. And that I think shows they have a lot more focus as well on a lot of their private investment opportunities through things like their deal room, which are kind of their accredited only Reg D offerings, as well as token offerings, right? I think that Republic has made it very clear that they're trying to make themselves the go-to digital asset, tokenization solution for regulated token offerings. So some of those maybe aren't being accounted for that in this today, but it's kind of just another interesting takeaway. Now, that being said, they still definitely do have offerings out there. So it's still one of the platforms, that I personally am looking at. Teddy, any takeaways from you in terms of looking at the trends and the different shifts in the top platforms since 2021 to 2023?
It's also important to note, for StartEngine, they've sort of become the leader in the space now and edging out WeFunder by 1%. But what's been great to see about them, and is probably attributable because they've raised a lot of money and have a lot of great backers, but they're also getting really active in the secondary space. So like they've totally built out that product line of allowing accredited investors to purchase secondary shares in like very large tech companies. I think Grok was one of them that they recently did. But the secondaries market is super active for accredited investors. So it's interesting to see StartEngine also start to build out some product offerings specifically tailored towards accredited investors, as opposed to, and it's interesting to see that they're still growing the non-accredited equity crowdfunding side of things as well. So they're growing their product offerings as well. Like you said, Republic is kind of going more towards the tokenized stuff. So kind of remains to be seen the traction they get there. But yeah, StartEngine, I think, wants to eventually be the one-stop shop for like accredited and not accredited. So it'll be interesting to see where they go next.
So I think, if you're an investor, all of this is important because depending on what you might like to invest in or prefer to invest in, there's kind of different channels and different platforms that seem to be focusing in certain ways where you might have a better chance of finding something that aligns with your investment thesis, your opportunities, knowing where those types of opportunities are being offered. And as an issuer, as a company, as a founder who's looking to raise capital, you want to make sure you're actually listing on a platform where that type of audience of investors is present, right? So it's very important to understand from both sides of the marketplace just how all of these platforms are kind of strategically positioning themselves. And, it's going to be I'm sure, continually changing, always evolving situation, but that's what we are here for, to help keep you in the loop. So before we sign off for the day, any final closing words from Teddy or Leah?
Yes, we talked about consolidation today, and we can see that the market is applying the Pareto rule. So the Pareto rule is also known as the 80-20 rule. And we see that in a lot of market where there are a lot of companies, 80% of the companies actually capture about 20% of the market. In the equity crowdfunding market, we see that 10% of the companies, only 7 out of close to 70 platforms, hold 88% of the equity crowdfunding market. So the equity crowdfunding market is actually even more consolidated into the hands of a few platforms than the Pareto rule predicts it. And I think that's also because we say that these platforms have network effects because they need to attract both investors and startups, meaning that the platform that has a good amount of deals is going to attract a large amount of investors, and the platform with a large amount of investors is going to attract even more deals, which is also known as the chicken and egg situation. And in this type of markets, the competition is usually characterized by, the winner takes all dynamic, where a company or a couple companies with the larger user base are going to dominate. If you think about typical companies with network effect that we know, we can think about social media, where we have Facebook, LinkedIn, Twitter kind of dominating over all of the other social media companies out there. And so what we see here is that StartEngine, WeFunder, DealMaker are really dominating the market. But I'm still surprised because I would have thought that the market would be way more consolidated, way faster than it is now. And I think that each of these companies have been able to differentiate themselves. They have their own particularities. For example, StartEngine doesn't take safe or convertible note, which means that WeFunder takes a lot of safe and convertible note. StartEngine really targets high raise, while WeFunder does not hesitate to list a lot of smaller raises on its platform. So because these platforms have kind of different personalities, I think that they attract a different type of startups and therefore different type of investors. But going back to DealMaker, we know that DealMaker is not really a platform. So Teddy, Brian, do you think that DealMaker also benefits or has to use network effects, or does it kind of work differently for DealMaker?
Yeah, I think DealMaker and Dalmore, like they really let the company portray the raise page like in whatever way they want. They don't necessarily have any templated formats to showcase the raise. So I think a lot of founders like that in kind of being able to have a lot of autonomy there and not having to fit into the mold of like the StartEngine format or the WeFunder format. Yeah, I don't know what that's going to mean in terms of whether, because as they get larger and like, because both of those companies doing great, but like, will it make sense for them to acquire smaller players? I'm not sure, because I think, and generally what we see on DealMaker and Dalmore is like these companies generally have like pretty solid traction, generally a little bit bigger and like a little bit further along, and they're very common for Reg A's, which obviously costs a lot more than running a Reg CF round. So companies generally have more capital and are overall further along in the life stage of the company. But it'll be, yeah, we'll see. I'm not sure, Brian, if you have thoughts on those two.
Yeah, they tend to be more, the types of issuers, as you mentioned, tend to be more mature, probably have more of a marketing budget. So for them, it's a little bit less important about being listed on a marketplace where anyone can kind of find you, because they tend to want to have more control over their audience and their marketing. So that's why I think some of the solutions built by, Dalmore and DealMaker allows more for a little bit more control like that, which allows them to kind of control more of their own marketing. And it's not as important necessarily for them to be able to have, people come from all places. In addition, sometimes you could say, if you're doing a fundraise as a founder of a company and you get listed on a marketplace type platform like WeFunder or StartEngine, it's great that other people can find you. But in the same way, it could be a potential negative, because you might send investors to your investment page and then they see, oh, here's this other company over here. And in that way, it allows them to really focus kind of that call to action on the investment also for your particular company. Again, there's no one size fits all correct solution to this question. It's kind of just different tools in the toolbox that are available to the founders depending on what their goals are. But, the network effect question is an interesting one, because if we take some of the ones that are more private out of the question and just look at the ones that are more of that public marketplace, it does have that network effect where, I think it's Metcalfe's law, and I'm probably going to misquote this, but it's something like where the value of the network is proportional to like the square of the number of nodes or something. So when there's, two people on a social network, okay, that's not very helpful because you can't connect with other people. But as more and more people join that social network, it's much more useful now for the people who are already on it, which is also then going to attract more people to want to join. So that's kind of this flywheel that we're talking about. And, when you have a marketplace with the investors and the founders, you can definitely see where something like that would also potentially come into play. Well, I think we've covered a lot of great ground today. We've talked about the Raise Green acquisition by Honeycomb Credit, and we have talked about the top platforms kind of broken down in terms of equity investments for Reg CF and Reg A. If you're interested in getting more great data-driven insights like some of the ones we've talked about today, make sure you head to pitchreviews.com and sign up. That gives you access to our free weekly newsletter where we will give you and send you all of these charts straight to your inbox. In addition, head over to Kingscrowd. Make sure you check out a lot of the great investment tools we have there, whether it's the portfolio tracker, where you want to try and find deals through our Deal Explorer. A lot of great startup investment tools there. We'll see everyone back here for next week.